Hello, I'm here today with Charlie Gibson from Edison Investment Research. We're here to talk about the new benchmarks for old report on gold. Charlie, can you tell me what's the report about?
The report's basically in two halves, and the first half picks up on a piece of work we did some time ago, where there's this concept of ounces in the ground in the industry, and they are defined as measured, indicated or inferred. And rather than having a general value for all ounces, we've distinguished between the value for measured ounces, indicated ounces and inferred ounces. We then build on that by looking at the various different discount rates used for companies at different parts of their development, and in the end we create a notional company that doesn't exist, and we value it at every single point of its existence, from the first resource down to the end of the life of the mine. Now that's the first part. The second part is looking at gold, the market for gold, and particularly what it should be worth in relation to the monetary easing by the Federal Reserve at the moment, and as it's called, the printing of money in the form of QE3.
And what was the main finding?
I think there are three main findings. I think, first of all, we get the different values for measured, indicated and inferred, and it shows up quite a geographic discrepancy between, in particular, the valuations given to ounces in the ground in Australia compared to Canada, compared to London. And in particular, it's noticeable in London. London doesn't like early stage inferred ounces. Canada doesn't like late stage measured ounces, and Australia likes all ounces across the board. So there's a very distinct geographical pattern that you can see. And I suppose on the second half, what did we find vis-a-vis the gold price? Well, given QE3, what we found was 1,676 was an entirely supportable price, i.e. roughly where the gold price is at the moment. Given that we believe the bull market is still intact, particularly because of ultra-low interest rates in the United States, that could peak up to about 2,600 in the relatively near term.
Did you do some work on returns as well?
Yes, we took the company, the notional company that we created, and we looked at where the best returns were for investors, and it showed quite an interesting pattern. Now, the first one is the most obvious one, which is as a company goes from explorer to producer, you get a roughly 10 times uplift in value, and that probably most investors could imagine or guess at. But the second most interesting time is when a company is still in the exploration phase, so there's no idea or notion as to how to mine this as yet, and that can give you returns which are comparable to those explorer to producer, but in a much shorter time frame. So actually it's possible in that phase of a mine's life to get higher annualized returns than you can from the shift to explorer to producer. The other time that would not be ordinarily recognized as being a good time to invest is right at the end of the life of the mine. Now that, as far as a mine is concerned, is where you've got stockpiles on surface. You're basically throwing them through the mill at zero cost. You're taking whatever gold you get at zero cost, and that is effectively pure profit. And you can get very, very good returns doing that. That exactly supports something that Mark Bristow from Randgold Resources has said with his mine, Marilla, which is at exactly that stage, which is he describes it as an ATM, and that is precisely what it is. And it's interesting that this analysis bears that out completely.
What about the second part, the part about the price of gold itself?
So what we're looking at is gold price, which we think, we had three theories on the gold price. And originally we said, when we saw the upswing, we said, all right, gold will behave like it did in the 1970s. Now, if it does that, then it would peak roughly where it is today, and then it would come back down to $1,000 an ounce. And in 2010, that was our expectation. What's happened now, however, is we've seen QE1, QE2, QE3, and the sizes of those, the size and extent of the quantitative easing is quite different from anything we've ever seen in history before in the United States, quite different from what happened in the 1970s as well. So we said, all right, let us instead look at a correlation between the gold price and the total US monetary base. And what that suggests is that A, the gold price where it is at the moment is about the right gold price. Secondly, that probably the bull market in commodities won't come to an end unless we see US interest rates rising, and we see very little prospect of US interest rates rising at the moment. So the third possibility we looked at is, what if there's no QE3? What happens if it stops too early? And then we conceived of a world, a little bit like the world from 1945 to 1970, where there were positive real interest rates. We conceive of a world of a long, long period of negative real interest rates. And what we ask is supposing they had as great a supportive effect on the gold price as positive interest rates do a depressive effect on the gold price, what would the gold price do? And the answer in simple terms is that it would steadily appreciate from the current level over the course of roughly the next 20 years.
And do you have any other conclusions?
I think that there are a number of other interesting conclusions, and one of them relates to value destruction in the industry, and there are several points where value is destroyed. A noticeable one quite often is when a company goes from a resource in the ground to having a scoping study. Now that's rather counterintuitive, but you do, if you look at the industry, you see it again and again and again, where first of all the company is valued on a resource multiple, and then when it comes out with a scoping study, which you would have thought would be in developmental terms an improvement, actually the price goes down. So that is one period of value destruction. The other period is when it raises equity in order to finance its capital expenditure, because it's increasing the number of shares in issue, and we can quantify that as well. The third time is in particular in London, where you go from zero resource to an inferred resource. I said earlier that London companies, the London market hates inferred resources, so that's one of the examples where there is value destruction in the industry. With the Canadian industry, it would be as you go from indicated to measured. And I think I said before, the London market, London market hates inferred ounces. So you see value destruction there. With the Canadian market, you would see measured. There are 4 points, roughly speaking, where a share could trade below net asset value, certainly for London. And those are when the company goes into a scoping study, when it's in pre-feasibility study, and right at the end of the life of the mine. Those 3 points, and with the London market as well, as you go from zero resource to an inferred resource. So it's interesting to know where the points of value destruction are, as well as where the greatest points of value return to investors are as well.
Thank you very much, Charlie. And if you would like any further information, please do visit the Edison website.